Imagine you work at the SEC in 2005. A 21-page memo lands on your desk. Its title is not subtle. The world's largest hedge fund is a fraud. Inside are nearly 30 warning signs and one simple way to test the entire story. Call an independent clearinghouse. Ask whether the trades exist. You never make the call. 3 years later, Bernard Madoff confesses, and $64 billion of reported wealth evaporates. The largest Ponzi scheme in history was not invisible. It had already been solved. The answer was there. Nobody verified it. To understand why the warnings failed, you first have to understand who Bernard Madoff appeared to be. He was not some mysterious salesman calling retirees from a basement. Madoff had been part of Wall Street for decades. He founded his firm in 1960 and built a legitimate market-making business. It executed real trades for major financial institutions and became an early adopter of electronic trading. Madoff also served as chairman of Nasdaq and advised people inside the financial establishment. He was not standing outside the system, trying to break in. He was the system. But hidden behind that legitimate operation was a very different business. Madoff also managed money for private clients. This side was secretive, exclusive, and strangely consistent. Its returns were not cartoonishly high, usually around 10 or 12% a year, just high enough to be attractive and smooth enough to feel safe. Inside the same Manhattan building, one business executed real trades. The other produced beautiful statements describing trades that never happened. The legitimate operation gave the fraudulent one what it needed most: credibility. This was Madoff's real protective mechanism, the prestige firewall. His reputation stood between the fraud and anyone asking uncomfortable questions. Investors did not see an unverified money manager. They saw a Wall Street pioneer, a former Nasdaq chairman, a man regulators appeared to respect. And once reputation becomes evidence, asking for actual evidence can feel almost rude. In late 1999, Harry Markopolos was working as a portfolio manager in Boston. His employer had heard about Madoff's extraordinary results and wanted Markopolos to reproduce them. This was not yet a heroic mission. It was a commercial assignment. Madoff was a competitor, and his strategy appeared to offer the financial equivalent of perfect weather. Good returns, almost no storms. According to Markopolos, it took him about 5 minutes to suspect fraud, then nearly 4 hours to build the mathematical case. The first problem was the shape of Madoff's returns. Markets rise, fall, and occasionally throw furniture through the window. Madoff's performance barely moved. Losing months were extremely rare. Market crashes seemed to inconvenience him about as much as a light drizzle. He claimed to use a strategy called split-strike conversion. The basic idea was simple. Buy a collection of large company stocks, then use options to limit potential losses while giving up some potential gains. Think of it as suspension for an investment portfolio. It can make a rough road more comfortable, but it cannot turn every mountain range into a perfectly flat highway. Madoff's results were too stable. Then there was the options market itself. To execute the strategy at the scale he claimed, Madoff would have needed to trade enormous quantities of options. Markopolos calculated that at times the required volume appeared larger than the market could realistically provide. So he began asking major derivatives traders a simple question. Had any of them handled these enormous trades for Bernard Madoff? Nobody remembered doing so. Markopolos could see only two plausible explanations. Either Madoff was using insider information to generate impossible returns, or the trades did not exist and the entire operation was a Ponzi scheme. One explanation meant financial crime. The other meant a much larger financial crime. Genius was no longer among the available options. Markopolos had not yet opened Madoff's books, but he had found the mathematical equivalent of footprints crossing a locked room. The question was no longer whether something was wrong. The question was how long the impossible could continue. Behind Madoff's impossible performance was a remarkably simple machine. When clients sent him money, he did not purchase the investments shown on their statements. The money entered a bank account. When one client requested a withdrawal, Madoff used money from other clients to pay them. On paper, everyone was becoming richer. In reality, the money was simply changing names. Imagine an airport departure board that keeps announcing flights, even though no aircraft are leaving. As long as passengers watch the screen instead of the runway, everything appears normal. Madoff's account statements were that screen. Every month, they displayed carefully selected stocks, options, and profits. The trades looked real. The dates looked real. The wealth did not. This is why the famous $64 billion figure needs context. It represented the total value displayed on client statements shortly before the collapse. Much of it was fictional profit accumulated over years. Madoff had not physically collected $64 billion in cash. He had created a mountain of paper wealth resting on a much smaller amount of real money. The operation became enormous through feeder funds. These companies collected money from their own clients, then sent billions to Madoff. In exchange, they earned substantial fees. They were supposed to perform serious due diligence. Instead, many treated Madoff's reputation as a substitute for it. The structure should have contained independent checks. The investment manager chooses the assets. A broker executes the trades. A custodian holds them. An auditor verifies everything. But Madoff controlled nearly every part of that chain, while his advisory business was audited by an astonishingly small accounting firm. The system had effectively been reduced to Madoff checking Madoff's homework and apparently giving himself excellent marks. But the machine relied on more than fake statements. It relied on exclusivity. Access to Madoff appeared limited. Clients often needed an introduction, and excessive questions could be answered with an offer to return their money. For wealthy investors, being told no can be a remarkably effective advertisement. Trust spread through country clubs, charities, families, and professional networks. People invested because someone they respected had already invested. Then they recommended Madoff to people who respected them. The scheme did not grow because every victim was foolish. It grew because each new layer assumed somebody in the previous layer had already checked. Nobody wanted to inspect the runway. The departure board looked perfect. In May 2000, Harry Markopolos delivered his first warning to the SEC's office in Boston. The document was 8 pages long. He explained that Madoff's returns appeared impossible and presented 2 likely explanations: insider trading or a Ponzi scheme. At that stage, Markopolos did not claim to possess a smoking gun, but he had identified the smoke, calculated its temperature, and drawn a map to the building. Little happened. He returned with another submission in 2001. That same year, 2 financial publications raised their own questions about Madoff's unusual consistency and his refusal to explain how the strategy worked. Still, the machine continued. By October 2005, Markopolos had assembled a far stronger case. His new report was 21 pages long and carried a title designed to remove any possible ambiguity. The world's largest hedge fund is a fraud. It contained roughly 30 red flags. The returns were implausibly smooth. The options market appeared too small to support Madoff's claimed trades. Major trading firms did not remember dealing with him. His auditor was far too small for an operation of this scale. And Madoff controlled the assets while providing the evidence that supposedly proved those assets existed. Markopolos was no longer offering a vague suspicion. He was providing a theory, supporting evidence, and a practical route to verification. He continued pushing warnings in 2007 and 2008. He also tried to interest journalists, and he was not alone. Other financial professionals, investors, and anonymous informants raised concerns of their own. The fraud was surrounded by people pointing at it. They simply lacked the authority to open the books. If you enjoy watching billion-dollar institutions receive the answer key and still fail the exam, consider subscribing. We also miss things occasionally, just fortunately not at this scale. As the years passed, Markopolos became increasingly consumed by the case. He later said that he feared for his safety. Billions of dollars were moving through the scheme, and he had no way of knowing who might be protecting their money. After Madoff finally collapsed, the public treated Markopolos as the man who had solved the mystery. He rejected the celebration. He described himself as a failure. Because being proven right after thousands of lives are damaged does not feel like victory. By 2005, the warning was detailed. The suspected crime was named, and the essential test was simple. Markopolos had done almost everything a whistleblower could do. Now, the institution responsible for protecting investors had to act. It chose to investigate almost everything except the question that mattered. The SEC did not completely ignore every warning. In some ways, what happened was worse. It opened files. According to the agency's own Inspector General, the SEC received 6 substantial complaints about Madoff between 1992 and 2008. It also knew about 2 financial articles questioning his returns. These warnings led to 2 investigations and 3 examinations connected to his advisory business. And yet, nobody properly established whether the trades existed. In 2004 and 2005, 2 SEC teams examined Madoff from different offices. For a time, both examinations were running simultaneously. Neither team knew about the other. Madoff was the person who eventually informed them. The examinations focused heavily on front-running. That is the illegal practice of using advanced knowledge of client orders to profit from upcoming market movements. It was a legitimate concern. It was also the wrong mystery. The central question was much simpler. Was Madoff trading at all? During their work, examiners discovered contradictions and caught Madoff making misleading statements. But instead of independently testing his explanations, they often accepted new documents or new answers supplied by Madoff himself. In one examination, regulators drafted a request to obtain independent trading data from the securities industry. They never sent it. Reviewing the information was considered too time-consuming. In another, a financial institution reported no relevant trading activity in an account the SEC was examining. That discovery should have changed the direction of the investigation. It did not receive meaningful follow-up. Then came the investigation triggered by Markopolos' detailed 2005 report. Once again, the SEC concentrated on narrower issues, including whether Madoff should formally register as an investment advisor. Investigators found inconsistencies. They received evasive answers. They even obtained information showing no options positions on a date when Madoff's strategy suggested there should have been some. Still, they never completed the independent verification that could have exposed the entire scheme. The tempting explanation is corruption. A secret arrangement, a powerful friend, a regulator quietly protecting Wall Street royalty. But the official investigation found no evidence that SEC employees were bribed or that personal relationships improperly determined the outcome. The documented reality was less dramatic and perhaps more disturbing. Inexperience, poor coordination, narrow investigative plans, excessive respect for Madoff's status, and a bureaucratic preference for checking whether documents were complete instead of checking whether the assets were real. The SEC verified the paperwork. It did not verify the truth. Worse, Madoff later used those failed examinations to reassure potential investors. He could tell them that regulators had already inspected his business and found nothing. The watchdog's failure became part of his sales pitch. The prestige firewall was no longer built from Madoff's reputation alone. It now carried an unofficial government seal. By 2008, Madoff had survived market crashes, skeptical investors, financial journalists, and repeated visits from regulators. Then the global financial system began to collapse. Banks failed, markets fell, credit froze, and frightened investors stopped admiring the profits shown on their statements. They wanted the money. Redemption requests began arriving from clients and feeder funds around the world. Soon, Madoff was being asked to return billions of dollars. But fictional trades could not be sold. Paper profits could not be wired to a bank account. And new deposits were no longer arriving fast enough to pay the people leaving. The machine had reached the one situation it could never survive. Too many clients asking for reality at the same time. On December 10, 2008, Madoff called his sons, Mark and Andrew, into his office. He struggled to speak and suggested they continue the conversation at his Manhattan apartment. There, he confessed, the investment business was a Ponzi scheme, the profits were false, the operation was insolvent, and, as he reportedly described it, the entire thing was one enormous lie. His sons contacted their lawyers. The authorities were informed. The following morning, FBI agents arrived at Madoff's apartment and arrested him. The largest Ponzi scheme in history was not uncovered by a forensic audit. It was not stopped by the SEC. It ran out of cash. For clients, the collapse was immediate and personal. Len and Marge Forrest had reportedly invested with Madoff for around 30 years. They believed they possessed an 8-figure family fortune. After the confession, they prepared to sell their homes. Approaching his 80th birthday, Len estimated that they had enough accessible money to survive for roughly 60 days, and they were far from alone. Retirees' lost savings accumulated over entire careers. Charities discovered that the money funding their work had never existed. Families who had recommended Madoff to relatives and friends carried a second burden. Not just financial loss. Guilt. Many victims were sophisticated. Others were ordinary people who believed that banks, professional fund managers, auditors, and regulators had performed the checks they were paid to perform. They had trusted a chain of institutions. Every link pointed toward the next one. The crisis finally pulled that chain tight, and it broke. If you enjoy understanding global chaos in slightly less chaotic ways, you know what to do. Now, let's keep going. In March 2009, Bernard Madoff pleaded guilty to 11 federal crimes. There was no dramatic trial, no final strategy to explain. He admitted that the investment business had been a fraud. 3 months later, a judge sentenced him to 150 years in prison. Several employees and associates were later convicted or pleaded guilty for helping manufacture records, move money, and maintain the illusion. Madoff died in federal prison in 2021, but convicting the people involved was easier than reconstructing the money. The $64 billion displayed on client statements had never truly existed. So recovery teams searched for real cash. They sold Madoff's properties and possessions. They pursued feeder funds, banks, family members, and investors who had withdrawn more than they originally deposited. They negotiated settlements across multiple countries. The process lasted for years. In December 2024, the United States Department of Justice announced the final distribution from the Madoff Victim Fund. That fund had returned more than $4.3 billion to over 40,000 eligible victims in 127 countries. For those victims, the recovery reached nearly 94% of their recognized fraud losses. Separate liquidation proceedings recovered additional billions for direct customers. Financially, the recovery effort was extraordinary. Humanly, it arrived too late to undo everything. Money recovered years later cannot return a home sold in panic. It cannot reopen a charity that closed. It cannot restore a retirement spent wondering whether the next bill can be paid. And it cannot remove the guilt carried by people who introduced their families to someone they believed was safe. Madoff bears primary responsibility. So do the people who knowingly helped him. But a fraud of this scale also required an ecosystem willing to stop asking questions. Feeder funds collected generous fees while sending client money into a business they could not independently verify. An auditor placed its name beneath financial statements it lacked the capacity to examine properly. Regulators discovered contradictions, then moved on. And institutions treated Madoff's status as protection against the possibility that Madoff himself was the risk. Some sophisticated firms refused to invest because basic due diligence made them uncomfortable. That matters. The warning signs were visible. Seeing them simply required accepting an awkward possibility. The respected people in the room might be wrong. Ordinary investors should not be mocked for trusting professionals. Modern finance depends on delegated trust. Most people cannot personally audit a broker, inspect an options exchange, or trace money through an international fund. That is why auditors, banks, fund managers, and regulators exist. They are paid to ask the questions individuals cannot. In Madoff's case, too many of those professionals became impressed when they were supposed to become suspicious. The lesson is not that trust must disappear. The lesson is that trust should reduce friction. It should never eliminate verification. Bernard Madoff possessed everything the financial system had been trained to respect. A successful company, a powerful network, an impressive title, and years of apparent approval from regulators. Harry Markopolos had something far less glamorous, an uncomfortable calculation. One man offered prestige, the other offered evidence. For 8 years, the system repeatedly preferred the prestige. Madoff's greatest protection was not brilliant mathematics or perfect secrecy. It was the belief that someone so respected must already have been checked by somebody else. That is how trust becomes a hiding place. And it leaves one question. When reputation itself becomes evidence, who verifies the person everyone has already decided to trust?